At its core, the objective of a financial audit has remained exactly the same for decades. An auditor must obtain sufficient, appropriate evidence in order to issue a true opinion on a company's financial health. While that ultimate goal is intact, information technology dictates the actual methods used to obtain and evaluate evidence. In a manual system, auditors inspect physical reality. They review paper purchase orders, match printed invoices, and verify wet ink approval signatures. Today, that physical paper trail is gone. Modern audit evidence consists entirely of invisible architecture, system workflows, electronic timestamps, and underlying user activity logs. Because the evidence is now entirely digital and mathematical, an auditor can no longer simply trust a printed report. They have to rigorously audit the IT system that generated it first. This introduces a strict paradox regarding automation. IT systems are highly successful at removing random human math errors, but they introduce a severe configuration risk. If a human makes a mistake on a tax calculation, it affects one invoice. If the wrong tax rate logic is programmed into a centralized sales system, that exact same error will consistently repeat across hundreds of thousands of transactions in a matter of milliseconds. The blast radius of manual fraud is limited by physical constraints. In contrast, a single user holding excessive digital access rights can create fake suppliers, alter bank accounts, and approve massive payments entirely on their own. Traditional manual review often fails to catch these compounded errors because they are easily hidden within massive datasets containing millions of daily transactions. When IT operates at this scale, a single technical glitch generates a systemic material misstatement across the financial statements. To evaluate whether a system is reliable, auditors deconstruct IT security into a specific architectural model containing two distinct control layers. The first layer consists of application controls. These are the specific transaction-level rules built directly into the software to prevent immediate data entry and processing errors. For example, an application control is the mechanism that automatically forces the system to reject a payment voucher if the user fails to input a valid pre-existing supplier code. The second layer is IT general controls, or ITGCs. These are the foundational, overarching policies that protect the entire computing environment and the infrastructure hosting those applications. This comparison chart breaks down the exact separation between these two layers, dividing the general environment on the left from the specific transaction processing on the right. Looking specifically at the left column, IT general controls secure the overall perimeter. They govern user access limits, dictate how program changes are authorized and tested, and ensure consistent data backups are maintained. This creates a strict dependency. Pristine application controls on the right are mathematically meaningless if weak IT general controls on the left allow an unauthorized user to bypass security and secretly rewrite the application's internal rules. The most critical element of the general control environment is user access control, which operates on the principle of least privilege. Restricting digital access so an employee only sees exactly what they need for their specific job role is the modern digital equivalent of physically segregating accounting duties. This diagram illustrates the digital audit trail, the chronological record that proves a transaction is legitimate. To rely on this trail, an auditor must be able to track a single transaction through these 5 steps. They need to prove exactly who initiated it, verify the electronic workflow that approved it, and check the precise timestamp of when it was ultimately processed. This is why shared passwords and generic administrator accounts are a fatal IT vulnerability. If a fraudulent wire transfer is executed using a shared admin login, the system logs the event, but it is completely blind to which specific human being sitting at a keyboard actually performed the action. Without individual accountability hard-coded into system access, the digital audit trail breaks down. It loses its integrity and cannot be submitted as valid audit evidence. When the audit trail is secure, auditors leverage technology to audit technology. They do this using computer-assisted audit techniques, or CATs. Traditional manual sampling is highly limited. An auditor might test 50 random invoices. CATs allow an auditor to extract and instantly analyze a full population of hundreds of thousands of transactions. This table outlines specific data analytics tests that auditors run against these massive, raw datasets. By scanning the entire population, auditors can immediately flag high-risk anomalies, extracting only the exact instances where a duplicate supplier payment was triggered or an invoice sequence check was broken. However, relying on data analytics introduces a new critical vulnerability: data integrity risk. This chart categorizes the reliability of electronic evidence, dictating whether a digital file is actually safe to test. Cautionary: notice the less reliable column on the right. If an electronic extract is generated using incorrect date filters, or if it is manually altered in a spreadsheet before the auditor receives it, the entire dataset is compromised. The mathematical rule of garbage in, garbage out applies strictly here. Massive data analysis only provides a false sense of security unless the auditor first verifies the complete integrity of the raw data source. Modern audit risks extend well beyond the company's internal servers. Financial data rarely lives entirely within a company's own physical walls. This table breaks down cloud accounting audit considerations, addressing the risk of trusting third-party service providers. The auditor must verify who controls the backups and establish what happens to records if the host fails. This reliance on external networks places cybersecurity on the critical path of financial reporting, making it a primary concern for the auditor. This diagram maps the cybersecurity risk pathway. A control failure leads to a cyber event, like a ransomware attack. Encrypting the ledger triggers data impact. The business is locked out, immediately creating a severe audit risk. When cybercriminals use phishing emails to hijack a payment workflow and alter supplier bank accounts, or hold ledger data hostage, they are fundamentally and directly altering the reality of the financial statements. When a catastrophic IT failure or cyber breach occurs during an active reporting period, the auditor has a highly specific mandate. The auditor is not an IT engineer. They do not fix the broken code, negotiate with ransomware attackers, or patch the security firewall. Their job is solely to measure the financial fallout. This framework outlines the auditor response to a cyber incident. If the incident destroyed core logs and backups cannot be verified, the auditor hits a limitation of scope. They simply cannot issue a clean opinion. Furthermore, if a severe cyber attack halts company operations entirely, the auditor is forced to evaluate going concern risks, whether the business can survive, and enforce mandatory market disclosures. The physical ledgers are gone, replaced by digital architecture, automated workflows, and complex data analytics. But those tools only calculate. Independent, professional audit judgment remains the irreplaceable core of the entire profession.